Hey everybody, it's Daniel here from InfoRest. Hope you're all doing well. So let's talk about the Canadian CPI numbers that just came out 40 minutes back. So the numbers basically came out in line, nothing crazy, nothing where we've seen a better than expected number, and nothing worse off. If we look at the headline number year over year came in at 2.5%. So inflation is up 2.5%. If you look at the month over month number, it came in at 0.4% in line. If you look at the core number that takes out the volatile numbers, takes out the oil, gasoline numbers, you got the number coming at 1.7% below the 2% target that's the central banks like to go for. So in line, but still, again, you have certain areas of the inflation report which is in terms of the prices still elevated. So let's talk about that. Let's talk about what went on in the inflation report. So I'm going to break it down here on the Stats Canada website. So basically, it says here lower prices for travel related services compared with a year ago. So they're seeing that traveling related services is seeing a decline. Prices for travel tours led the deceleration in all items CPI, falling 2.8% year over year in July, following 7.4% increase in June. The decline was largely due to base year effect as prices for travel tours rose 15.5% month over month in July 2023 during the first summer without restrictions related to COVID. Similarly, prices for traveler accommodations down 3.7%, air transportation down 2.7%, and they fell year over year in July. On a monthly basis, prices for travel tours positive 4.5%, air transportation positive 8.4%, and traveler accommodation plus 7.1% were up in July. So yes, you're seeing travel get hit a bit because, of course, people are feeling the pain when it comes to all this higher rates that we've seen, the inflation, and like I've been talking about on this channel for quite some time, the demand, right? Where the reason why, okay, let me repeat this again. Probably if you follow this channel for some time, probably hear me say this multiple times, but for those who are new, let me say it here again. The reason why you're seeing inflation and CPI come down is because you're seeing the demand weaken. Demand is weakening. The economy is weakening. In order to get inflation down, you do need the economy to weaken. And like we've seen previously in previous recessions, when we see a recession hit, when we see that demand crunch hit, the unemployment rate go up, lo and behold, you see inflation come down and meeting the central bank's target, right? Moving on, prices for passenger vehicles continue to decline. Prices for passenger vehicles fell 1.4% year over year in July, following 0.4% decline in June. This deceleration was driven by slower price growth for new vehicles. As inventory levels improved compared to July 2023, at the same time, prices for used vehicles fell 5.7%. So there you go, right? Vehicle prices, yes, the supply is coming back online, but also the prices that were so high up. If you remember, if you were looking for a car or vehicles during that time, during the COVID time, even a little bit after COVID, 2021, 2022, 2023, the prices were really high, even for used vehicles. Now you're seeing the used vehicle market drop quite significantly, and you're going to see more of this. You're going to see more inventory show up, more supply show up, less people buying because, the loans are much higher, the interest rates are much higher. People who took all the stimulus money and all the money that they made during COVID time, bought expensive cars, are also realizing it's too expensive because grocery prices are high, shelter is high. So what are they doing? They're getting rid of their cars, They're expensive cars. So that's also bringing up the inventory. Demand is high. People are, less in looking for vehicles. Therefore, the price is coming down, which again gives you bargaining power if you are looking for a vehicle. Now, just wait another year or so. We might see those prices also continue to decline as the demand gets worse and worse. Gasoline prices rose, so that rose at a faster pace year over year. Gasoline prices rose at a faster pace in July, plus 1.9% compared to June, plus 0.4%. Prices accelerate the most in the prairie provinces, and so on. So let's let's move on and talk about some components in the CPI and see how they fared in the July month versus the June month. So again, like I said, July 2024, the CPI number came at 2.5%. That's your headline number there. This is slightly lower than the 2.7%, but still, it's 2.5%. There was an increase in July for July month for the inflation numbers. So still positive number, still 2.5%. Yes, a little bit lower than June's number, but it's still up there. Now, when you break down the components, look at food. Food came in at 2.7%, so food is still expensive. Funny, we need it, and it's still expensive. Compared to June 2024, which is 2.8%, so slightly down, but doesn't really change anything. Now, shelter came down. Again, it's still up there. June's number was 6.2%. July has now come down to 5.7%. That shelter component is going to take time, and we're going to see it, play in. We're going to see it play in a little bit later for that number to come lower, especially, like I said, when we see that recession, that demand crunch, right? But that's going to take its time, and it's still going to be sticky. It's still going to be up there. Household operations, furnishing and equipment, of course, this is quite obvious, negative 0.1. Now, the last June's number was 0.9%, negative 0.9%, right? So a little bit of you could say prices going up there, but again, it's still in the negative territory because who's going out and furnishing their house? Who's going out and spending money there? No one really. People are just trying to save their money. Clothing and footwear, negative 2.7%. June number was negative 3.1. Transportation stays at 2%. Healthcare, personal care, 2.9%. Recreation, education, and reading, negative 0.2%. Alcohol, beverages, tobacco, recreational cannabis, 2.7% versus June of 3.1%. So the biggest takeaway here is your food and shelter is still up. The prices are still up. Inflation, overall, the CPI report, yes, there's certain segments where you're seeing the decline. You're seeing the decline in household operations, furnishing, clothing, footwear, travel, vehicles, right? But the most important area that we all need is the food and the shelter. That has yet to come down. And yes, the CPI overall is coming down from its peak that we saw previously, but we still yet to see more of the food and shelter component come lower so people can breathe again. Now, the problem is there's a catch, right? If you truly believe that this is all going to come down and it's going to be a soft landing and a Goldilocks economy where economy is going to do fine and we're not going to see a complete recession or crash or anything and inflation is going to come down, then you're not worried. But if you look at history, we could see the inflation come down and for that food and shelter to come down once the unemployment rate ticks up and the recession hits. We're seeing that. We're seeing that with the jobs. We're seeing the unemployment rate tick up. And I think we're going to see a hard landing rather than a soft landing. And that's where you're going to get the inflation to come down in those other components like food and shelter. It's going to take its time. But again, it's happening. It's slowly happening. And for CPI to come down to where it is right now is because it's a telling sign that demand is getting weaker or weaker. Consumers are hurting. Simple as that. So anyways, let me know what you guys think. Leave a comment below, subscribe, hit the like button, bell icon to be notified in the next video, and I'll see you guys around. Cheers, bye.